think it's recording. Okay. So accountant's liability again. I know some of you are planning to take the CPA. This will help you with that exam. For those of you that are not, it's still good to be familiar with some of the legal liabilities that can happen. Because in the business field, a lot of you will end up working with accountants, auditors. You might be an accountant yourself. If you own a business, you could be working with a bookkeeper. You want to be aware of some of the issues that could come up. So today we'll talk about the major regulation in the accounting field and the business field when we talk about accounting is the Sarbanes-Oxley Act. Okay, so we'll talk about that and how it has a role in accountants' liability. We'll also talk about the liability accountants have to their clients. We'll talk about requirements for accountants under these two other laws that exist, the Securities Act of 1933 and 34, and then we'll talk about some of the criminal liability that exists. So the Sarbanes-Oxley Act, I'm a Red Sox fan, so I say the Sox law. I just want to make sure that you guys don't think of Red Sox every time. Sarbanes-Oxley, S-O-X, Sox, so they call it the Sox Act. This law was something that happened as a result of a number of really big scandals. So while they weren't breaking the law, remember, ethics and the law aren't always the same. While these companies weren't breaking the law, there was these huge companies. You'll hear of them and probably have before. WorldCom, Tyco, and they were kind of most admired, big companies in their ages, and they were doing some stuff that was unethical, but not necessarily breaking the law. So as a result of that, they came out with the Sarbanes-Oxley Act. So for those of you taking the CPA exam, this links right to all the different requirements. For the purposes of our class, we'll talk about just some of the major ones you should be familiar with for the business field. Okay, so we see a bunch of these different firms. Enron, for example, most admired. They were doing some really, really shady stuff. So what it was called, you might, if you're interested, email me. I have all sorts of fun information on this. And if you take an ethics class, you will definitely look at this. Enron was this firm that was doing really well, most admired, had a lot of investors, and they were doing something called mark-to-market accounting. Kind of a simple way to put that is they get a new client coming in and they'd say, I think we're going to get $1 million from this client. So they booked the fact that $1 million was coming in based on this new project, and then the money never actually would come in. So while they said, hey, we have $1 million in revenue, there wasn't $1 million in revenue. So you see a company that's making all this money, saying they will make all this money, and you think, I should invest in that company, right? That all these people investing in them thinking that they were doing really well, when in fact they had a lot of debt, and they were hiding that debt in this huge complicated matrix of what we call shell companies, so fake companies that could hide that debt. So they got pretty creative in how they hid the debt and claimed they had profits that didn't actually exist. That seems crazy that a company could do that, and that's why, as a result of these types of issues, they go bankrupt, all their employees lose their jobs, any of the money they have in retirement, and then on top of that, the investors, they have all this, what they think is valuable shares in a company. The company goes bankrupt, there's nothing left. So it was a very interesting scandal. If you're really interested and you want to, our very last project in the class, you can watch a movie and relate it to class. There's a documentary that's like a very, if you're not into documentaries, I promise it's not boring. A documentary called The Smartest Guys in the Room. You can take a look at this. We look at this in ethics because it's kind of like the foundation of, hey, this was a big ethics issue, don't repeat it. Unfortunately, we see this being repeated still today with other firms. So as a result of this crazy situation where you're going, wow, a company that large affecting that many people could get away with what? They made this law called Sarbanes-Oxley, and this applies to any company in the U.S., based in the U.S., that does what? Thanks, Diane. Remember, all the answers are on the board, so you can get engaged. Diane's getting engaged. Listen, if you were bought and sold on a New York Stock Exchange, for example, or any exchange where someone can invest in your company, we want to make sure the information's clear and honest. And so that's the idea behind Sarbanes-Oxley. If you're a public company, you're buying and selling on an exchange, then you need to follow the requirements of this. That doesn't apply to someone saying, hey, I'm going to sell handmade necklaces to my friends at school. You don't have to follow Sarbanes-Oxley. Many businesses will follow some of these requirements voluntarily, but it only applies to public firms. I'm so sorry. I think I got a little fancy with Prezi, which really just means you might get dizzy. So as part of that law, often the laws enact these boards to help implement them. So here we see the Public Company Accounting Oversight Board, PCAOB. They were created to help ensure investors get accurate and complete information. So that when you invest in a firm and the firm says it's profitable, says it has low debt, you can feel confident that that's accurate and complete information. So they help make sure that SOX is being enacted correctly. Now, here are some of the requirements in the Sarbanes-Oxley Act. For an exam, I might ask you to name a couple of these. So I'm not going to say, hey, remember every single requirement under this law. That's difficult. But what I want you to at least be familiar with is some of these requirements because they will impact you. You'll see here, for example, auditors have to communicate regularly with audit committees of its clients. So what is an audit? Yeah, someone's coming in and making sure. So again, even if you're not an accountant, if you own a business or work for a business, you'll probably be involved in an audit. Sometimes it's someone coming outside the company to make sure everything's clear and working out well, checking for any red flags. And sometimes it's happening internally and making sure the process is smooth and there's no kind of red flags there. So this says there has to be this communication so we can make sure that they're getting the information they do need to conduct an audit. Now another requirement, you'll see accounting firms that audit public companies, that help make sure public companies are giving correct information. They also cannot provide consulting services. So if you're helping to do an audit for a firm, they're your client, you can't also serve as their advice, their consultant. So let me give you an example of this. When I worked for Deloitte Consulting, one of my clients was the Department of Health and Human Services. We helped them with consulting services. We helped their upper level management make sure that they were using their resources well, meaning that their workers were doing what they were supposed to be doing in a timely manner, an efficient manner, and along with some other things. And so we were dealing more with giving them advice. They hired Ernst & Young, which is another accounting company, to come in to do their audit work. They would help make sure that the statements, their financial statements they were preparing, talking about how they were using the budget they had coming in, that they were accurate and complete. So that way if they said, hey, we have $1 million and really it's supposed to be $2 million, someone's checking that information to make sure it's correct. So they're just separating the services. You can't have the same person doing consulting and doing the auditing, because then you run into this issue of checks and balances and they can be kind of hiding information. That also speaks to this idea of conflicts of interest. What's a conflict of interest?
If you have an interest in the business, or if you have a stake in it.
Okay, so Klima says like an interest in the business or stake in the business. Yeah, if you have something that would bias what you're doing for the business. Okay, so a conflict of interest. I have a conflict of interest. I was asked to be on what's called the Georgetown Preferred Committee here at Montgomery College. They allow certain students to apply to be what's called Georgetown Preferred. If they're applying to Georgetown University, they can apply to be basically one of 3 students that the school says you should accept this student to Georgetown University. So they asked me to help out with that process. I have a conflict of interest. I work with the Macklin Business Institute. It's an honors program. I'm one of the faculty advisors. We have a lot of students who apply to Georgetown University from that program. I also have students who are not in the Macklin program who are applying. And so I'm kind of biased in that I work with all these students. I have more than 3 applying. I'd have a hard time deciding which 3 to put forward for that preferred programs. I just stepped out of it so I can remain objective. I have a little bit of a conflict of interest. Now, another requirement under Sarbanes-Oxley is that there can be criminal sanctions. So when Enron happened, we had these people who were doing stuff that was definitely not okay. It was ethically wrong, but a lot of it was not illegal. So this created sanctions. It said, hey, if you do these kind of things, you can get in trouble. You can be imposed with fines, and you can even go to prison if you're involved in this type of conduct. It also set what's called term limits on audit partners. So a lead audit partner can't work for a client for more than 5 years. Here's why. When I was at Deloitte, I talked about that client. There was one specific executive. Her name was Margie. Her and I worked really closely. I was her consultant. I advised her on really important issues on a daily basis. You're working with someone 50 hours a week or more. You're going to get close with them. So even though she hired me and she was paying me as a consultant through Deloitte to help her, we built a personal relationship, professional relationship as well. So do you think she wanted me to be successful? Yeah. And so after 5 years of being with someone and being that close with them, they want you to be successful. Yet if you're doing an audit of someone's company and you need to report that things are not okay, do you think they're going to like that? No. So Margie, if I have to do an audit of her and say, hey, Margie, you're the manager, you're in charge, but your business, you say you're making money, it's a lie. You guys are not making money. Or you say you have this great system in place to check and make sure there's lots of security, there's not. That makes her business that she's running look bad. So it could be difficult, you can feel pressure not to share that honest information, right? So that's why they put limits on the amount of time that you can be on the project so that they can take away some of that relationship that you built and make sure people remain objective.
Obviously, I'm assuming that would tie into the conflict of interest.
Absolutely. It would cause a conflict of interest. There is an inherent conflict of interest with auditors. They are hired and paid. Now, Health and Human Services hired and paid Ernst & Young to do an audit of their company. That's a big contract for them. If they want to do that same audit next year, to then say, hey, this company did a bunch of really, really bad stuff, do you think they're going to hire them again next year? So there's this weird inherent conflict of interest where they need to be honest and be accurate in the audit. And if there's something wrong in the company, they should share that information, but they also want to get their business. So yes, there's a conflict of interest and it's a problem. This is the big one. Pay attention to this, even if you don't want to be an accountant. Many of you will be at a high-level executive position in a firm down the road, I hope soon. This was one of the problems with Enron. The executives were going, well, I don't know how to read a financial statement. I'm not an accountant. Yeah, it said that we were really profitable and we weren't, but I didn't know. This removed that defense. You can't just say, I'm unaware of financial issues. I'm not an accountant. If you're a high-level executive at a business firm, you will be required to sign off on those financial statements. So I served on the board of a nonprofit. I had to sign off on the financial statements. I was in a room where we discussed those financial statements, and I had to say I was aware of them. I'd be in a lot of trouble if I wasn't making sure that information was accurate. So what you don't want to happen is you work for a company and you lose a bunch of big clients and you know that you're in debt. You know that you don't have a lot of money coming in, and your accountant shows you a financial statement, an income statement that says that you're making tons of money. Does that seem weird? I know it's Monday morning and it's early, but if you know that you've lost a bunch of big clients and you know you don't have a lot of money coming in and you have a lot of money going out, and someone's telling you you're really profitable in your business, does that seem weird?
Yeah.
So that's what you need to know as an executive. It's a red flag. Does it mean it's not right? Not necessarily, but you need to look into it. You have an income statement saying you're very profitable, and you as a business owner knows you've been spending a lot of money and you don't have a lot of money coming in, and your auditor's telling you or your accountant has a financial statement telling you you're profitable, red flag, double check. You can't just say, oh, it says I'm making millions of dollars, it must be right. Sign off on it and then say, well, I didn't know there was a lot of lies on there. Why would someone lie and say a business is making $3 million when it's really only making $1 million? Yeah. So it makes sense. More people to invest. Yeah, if you're going to invest in a company, you want to see lots of revenue in that company. So they have an interest in inflating the amount of money coming in their profits. So people would lie on their statements, and the Sarbanes-Oxley Act, the goal is to try to make sure people are not lying, and there's checks to make sure that information is accurate. So accountants' liability, they have some liability to their clients based on this contract liability. They have a contract that they make, it's usually in writing, and they call it the engagement letter. So again, even if you're not an accountant, you might do an engagement letter to hire an accountant to come make sure that your firm is doing things correctly. Here, the accountant is expressly promising in the contract to complete a particular project by a given date. So for example, Ernst & Young, in that example I gave you earlier for when I was working at Deloitte Health and Human Services, they had an engagement letter with saying they would have their financial statements checked and back to them, making sure they're accurate by November 15th, which is the day they had to be shared publicly with everyone in the United States online. So it was really important that they promised not only to complete that information, we will make sure to check all of your financial statements, but also that it was done in a timely manner, because Health and Human Services had a requirement under the law to share by November 15th publicly. So if they breach their contract, they're late, it makes Health and Human Services in violation of their own regulations. So you can sue and say, hey, you broke that agreement, you broke the contract. The other way you can sue, we're going to learn more about on Wednesday and Monday. We're going to cover torts. Torts in the law means wrongdoing. We're going to spend a couple classes on torts because it's a lot of what we see in the workplace. One type of tort is called negligence. Okay, so you can be negligent to your clients. You have a duty to do good work for your client, and if you fail to meet that duty and it results in harm, you could be negligent. Okay, does that mean if you make a mistake on the job that you could be liable for negligence? You're an accountant and you say 2 + 2 = 5. It was an accident though, honest mistake. You know, you just wrote the wrong thing or you hit the wrong number on the keyboard. Are you going to be thrown in jail? You probably lose your job, but you're not necessarily going to be thrown in jail. That's the type of negligence. Okay? What we want to make sure is that you're doing your duty. Okay? As an accountant, were you being careful? You know, as long as in good faith you were being careful. For example, 2 + 2, you know, you said it equaled 5. It was an accident. But you have a check and balance in place where, you know, you're supposed to check your work and say you checked your work, and you did check your work the second time. While it was still wrong, you can show, hey, you know, I checked it twice. I didn't mean to do this wrong. You're showing what we call due diligence. It was just a mistake. It's okay to make mistakes. You might lose your job because that can harm the client. But under negligence, you want to make sure you're doing your job in good faith. You're trying, you know, you're checking your work, that kind of thing. So again, if your accountant breaches their duty to the client, you fail to exercise this good due diligence, the degree of skill another accountant would do, and it results in harm for the client, you could be found negligent. So you want to do your job, and if you say you're checking your work, check your work, that kind of thing. You can also be liable for fraud. And we've heard this word before, fraud. Gosh, I hope no one's experienced this. I've gotten hit with fraud way too many times in my life. Someone had my credit card for 2 weeks. They went out and bought a bunch of stuff in Michigan lately, and I had to switch credit card companies finally. They went to Tim Hortons and vending machines. For 2 weeks, they were just spending $1 here and there, and it just took us a little while to catch them. So that's an idea of fraud, intentionally deceiving someone. Accountants can be liable for fraud if you make a false statement of fact. If Joanne says XYZ company has $3 million in revenue, and in fact it only has $1 million in revenue, does that seem to be a misstatement of fact? Yeah, so that's where she can be in trouble for fraud. And again, she might want to do that because it makes the company look like it's performing better, which means more investors, more money coming in. If you know something's not true, obviously that's fraud, right? I'm saying that it's $3 million and I know it's $1 million. The other way you can be in trouble, it can be fraudulent, is what we call reckless disregard. It's not that you knew it was a lie, but if you had just checked a couple of different documents or asked anyone, if I asked the Chief Executive Officer, Rebecca, hey, is your company doing well? Are you guys making $3 million? That seems like a lot. Are you making $3 million? She would have said, no way, we just lost a huge client. I hired a bunch of people. I have more money going out than coming in. If all I had to do was check with Rebecca, but I didn't, it's called a reckless disregard of the truth. If I just checked with anybody, I would have found out that information was wrong. So you do want to make sure that you're just, again, doing your due diligence. Now there's also something called breach of trust. Accountants have a legal obligation to keep all client information confidential and use client information only to benefit the client. This is important because if you're working with a company, that knows information. I'm doing the accounting work for a company and I see that they're doing well and they just purchased a really big company and it's not public information yet. I'm going, hey, I'm going to go invest in that company. I'll have my husband invest in that company and then we can make a ton of money, right? Here it's saying accountants can't do that. You have to keep information private. So for many of you, you'll go work for big consulting firms every day, same time. You'll work for big consulting firms. When I worked for Deloitte, they have a lot of different clients, a lot of financial institutions, and it limits who you can work with. For example, my husband and I were getting a mortgage at the time I worked at Deloitte. There's only 2 companies we were allowed to get our mortgage from because all the others were clients of Deloitte and we can have a conflict of interest then. So the idea here is they're trying to keep information private and trying to avoid some of those conflicts of interest we talked about. Another example, my husband works in the healthcare field. He's an attorney for the Office of Inspector General. He helps deal with different fraud. He's the opioid guy. He deals with opioid issues, all kinds of fun stuff. If he finds out that, XYZ pharmaceutical company just got approval for a really great new drug that cures cancer, do you think they're going to have a lot of investors and start making good money?
Absolutely.
But if he knows that, and the public doesn't know that, that's private information. So if he then takes that information, knowing that they get
Insider
approval.
trading.
Thank you. Insider trading. So you want to be careful. If you have information that's what we call inside information because you're the company's accountant, so you find things out like that are not public yet and you use that to your benefit, you could end up in jail.
Isn't that what happened to Martha Stewart?
Thank you. I have an ethics class I teach online at the University of Massachusetts. That's what they're looking at right now. Martha Stewart ended up in jail. She had insider information. You sell stock or buy stock based on that. If it's not public information, it's not fair. Everybody else is buying and selling stock based on public information. So that's the idea here. Keep information private. There is also a duty to third parties that varies depending on which law the state is using. An easy way to look at this, the ultramarines doctrine is saying if you fail to exercise due care to a third party, you have to know the third party would use the work product, the information you have, and would rely on it. Down here, the restatement doctrine says you have a duty pretty much to anyone. So a quick way to remember these, the ultramarines doctrine, if a state is following it, is the most strict. It's saying you really have to know someone would take this information and use it. Down here, the restatement is saying really anyone. If anyone could rely on this information, you could be responsible to them. So up here, in this situation, if I follow the ultramarines doctrine, maybe the banking institution, someone who's going to give you a loan, I know they'd see the work product. They'd rely on it in deciding whether or not to give a loan. So an example of work product, if you're an accountant, you're making a financial statement, like an income statement, or we call it a profit and loss statement, showing how profitable the business is. That's often used by banks to decide whether or not they want to loan money. So here I'm an accountant and I'm making that profit and loss, that income statement, and a bank's looking at that. It's pretty practical. A bank would see it. So if I know a bank would see it and that they then would rely on it to decide whether or not to give the loan, I could be responsible to the bank. Even though I don't have a contract with the bank, they're a third party, they're involved. Under the foreseeable doctrine, it has to be foreseeable. I don't have to know that they'd see that document. It's foreseeable a bank would see that document. I could be liable to them. Down here, really anyone. If it's, hey, this person who works there, their husband saw it and made a choice based on it, you could be liable. So liability ranges to third parties, but if other people are harmed because you lied making someone's financial statement, you could be liable not only to the client, but to other people as well. There are a couple other regulations when we talk about accountants' liability. So the Securities Act of 1933 and 34. 33, you'll see under Section 11 of this act, auditors are liable for material misstatements or admissions in the financial statements. Let's talk about that in plain English. In the financial statements, we were helping that Health and Human Services work with. Their financial statements were in the millions of dollars. So if they had a typo and 2 + 2 = 5, they were off by literally $1 million. And yes, that happened. We caught it because we had good checks and balances, but that happened. So they had to put information in their financial statements about an issue going on. This is a really interesting story. There was an Indian tribe that they went to court and they received $1 million from Health and Human Services. They won. Okay, they were disputing something, some of the health care there, and they got $1 million. Now, that was one Indian tribe. Based on precedent, do you think others could also get $1 million if they brought a similar case? So that was what Health and Human Services was trying to figure out. It's called what we say a contingency liability. While that expense hasn't hit your business yet, is it possible it could? Yeah. If we say, hey, there's one tribe got $1 million, there's 30 tribes, there could be a $30 million hit over the next few years, right? It would be dumb of you as a business owner to ignore that. Is that material? Does that belong on their income statement? Do you think people would be interested in that information? No one's actually brought them to court yet. They don't actually owe anyone $30 million. So is it material? Let me try again. Tell me if it's material if they did have $30 million that they owed various Indian tribes. Then is it material and should be included in the financial statements? If there's just that potential, should it be included?
Yeah.
You're all right, because guess what? That was the issue we talked about for over a month. We had the legal counsel trying to make a decision about whether it was material. The chief financial officer is trying to decide whether it was material, and then if it is material, how do we clearly reflect that information? Can we put it down in like a little footnote under the financial statement, or does it need to be shown as an expense? So the issue it usually comes down to is whether or not it's material. The safe way to go, what we ultimately decided, was to do what? Put that information in there, disclose it, because it's safer to disclose it in case it is material. To say like, hey, this could happen, there could be $30 million in debt coming, was the honest truth. So giving more information was more helpful, and that way we don't have a material misstatement by not including it. Now over here under the Securities Act of 1934, this one's big because this is where you'll see the fraud comes in here. So we've talked about under Section 18, an auditor who makes false or misleading statements. Okay, you can be required, in a required filing, you can be in trouble. Now before we were talking about that under common law, state law, under federal law as well, you can be liable if you lie on these financial statements. Or if you see them and say they're okay but they're not. So over here, fraud, this is a federal law saying fraud under Section 10B of the 1934 Act. If you make a material misstatement or you admit to tell them something, if we left that $30 million potential debt off the statement, if we do it knowingly and we know we're lying, we know the information's wrong or that we left something important out, or recklessly, we should have known, and then someone relies on that in purchasing or selling stock, you can run into an issue of fraud. Now here's where the case came up about that. So again, this is to help illustrate that concept. This is a real case. You'll see Ernst & Ernst versus Hochfelder. Here's a company. For 19 years, Ernst & Ernst audits a small brokerage firm, First Securities Company of Chicago. Leston B. Ney was the president of the firm. He owned 92% of its stock. So he owned most of the business. He convinced some customers to invest funds in an escrow account that would yield a very high rate of return. You put $1,000 in, you're going to get $1,000 plus an extra $300, and they're going, wow, that sounds good, right? So, indeed, they listened to him, 1942 through 1966. So we see this going on for a long time. We see them investing in these escrow accounts expecting to get a lot of money back. The investments were unusual in that the customers would actually write their checks to Ney personally. Who should they have written the checks to? Lillian, you can say it louder. The company, to First Securities, right? It should go to the business. It's a brokerage firm. Instead, they were writing them directly to this guy, Ney. As you might have guessed, there were no escrow accounts. Ney was actually taking the customer's money, putting the checks in his pocket. He was able to cash them because they were written out to him personally. So the fraud came to light when he actually took his life. He committed suicide. He killed himself. The fraud comes to light. He left the note that described First Securities as bankrupt and that the escrow accounts were spurious. In investigating this fraud, we have this guy taking these checks that were supposed to go into this investment. Instead, it's going into his pocket. He's cashing them using the money. So, in fact, his company is going bankrupt. They investigate it, and the customers discovered that Ney had this really strict rule which prohibited anyone from opening mail addressed to him, even if it arrived in his absence. So no one could open any of the mail at the firm. That's a little weird. We'll talk later on when we get to our contracts chapter. There's some situations where you're obligated as a business to respond, or it can be an acceptance by failing to respond in a matter of days. So usually you'll have a secretary or someone who can look at the mail and make sure it's nothing super important if you're out of town.
I just want to ask, is that a federal crime to open somebody else's mail?
It is to open somebody else's mail, but usually if you're the owner or the high-level executive in a company, it'd be normal that something could be addressed to you that's important and that you'd have a secretary somewhere on your behalf. If you've given them permission, they would open it. Here, he didn't give them permission. He had a rigid rule saying you cannot open my mail no matter what. The customers were upset because, normally that rule itself, it's okay to have. But if you just ask any questions, these auditors, Ernst & Ernst, they would have heard of that rule and gone, that sounds kind of fishy, right? And likely they would have looked into this further. It was just a red flag they probably should have looked into. So the customers alleged that Ernst, not Ney, not First Securities, Ernst should have done a proper audit. So did Ney mess up? His company, First Securities, are they probably in some trouble? This is saying like the auditors who are checking to make sure the company was doing the right thing, they also are in trouble. So Ernst & Ernst should have done a proper audit. If they had, they would have found out about this mail rule, and they would have known there was a problem. Michael?
So to classify it, would Ernst & Ernst be being sued under negligence?
Great question. So here they're being sued for negligence, we could say probably. Did they do their due diligence? The issue in this case came down to, well, it's not just negligence. They didn't do what they should have been doing. Was this fraud? So is it also fraud? Is it also a federal violation of the Securities Act of 1934? Here, there's a suit against Ernst under that fraud, section 10B. The accounting firm files a motion for summary judgment. They say just dismiss this. Under 10B, you'll see it requires what we call scienter, some type of mental state, which is an intent to deceive. So the question in this case is it fraud under 10B? Do you have to have intent to deceive to be considered fraudulent? Did Ernst intend to deceive all these people?
No.
They did, right? Did Ernst & Ernst? No. You know, they probably should have asked some questions and they didn't, but were they trying to deceive people? Probably not. So the issue in this case that they're looking at is, does it require intent? Do you have to be trying to trick people as the auditor in order to be found liable under 10B for fraud, as well as negligence? Negligence, probably they're in trouble. So here, were they liable under 10B when they acted negligently? Or they should have asked questions and didn't, but not intentionally. They made a mistake, but they weren't trying to hide information. So here you'll see, we've talked about this before, when we're unclear in the law, they'll look back to certain information like what was intended and what's good for the public. So you'll see here it says, thou shalt not devise any other cunning devices. The commission should have the authority to deal with new manipulative devices. It's difficult to believe any lawyer, legislative draftsman, or legislator would use these words if the intent was to create liability for nearly negligent acts or omissions. So under this law, from this case, we see to be liable for fraud, it means to be intentional. So certainly they can be in trouble with negligence. Okay, they probably didn't do what they should. But if you worked at this accounting firm and you failed to ask those questions, you weren't trying to steal those good people's money, you're not going to be in trouble under 10B for fraud. Now, a couple other areas to talk about. First of all, aiding and abetting. The Securities and Exchange Commission is one of the agencies that deals with a lot of these regulations we've been talking about. We just saw those two acts. Here you'll see they can prosecute anyone who aids and abets. What does that mean?
If you're an accomplice to it.
Yeah, if you help.
Yeah.
If you help someone do something wrong, you can be in trouble too. So here, the SEC can prosecute those who help other people in making untrue statements. Okay, so if you're lying on the financial statements, or you're helping someone lie on the financial statements, then you can be in trouble too. The SEC can come after you. Now, something that came about as a result of this is what we call whistleblowing. When people are lying and doing wrong things in companies, it's really hard to figure that out. Now, unless you start asking the right questions and someone tells you the information. So whistleblowing is, what's a whistleblower?
A snitch.
Thank you, Sean, because every semester that's how the students remember, and that's fine with me. Whatever helps you remember. You can say a snitch. What's a snitch?
Tattletale?
A tattletale, someone who shares information. So a whistleblower is sharing information about illegal or unethical conduct going on in a firm. So we have a lot of laws in place to help protect people who report, basically, snitch or tattletale, wherever you want to put it. They're reporting bad acts that are going on in an organization. We want to protect them. The idea there is to try to get more people to say something when there's a problem going on, to snitch or tattletale. So under Section 10A of the 1934 Act, we have 10B for fraud. Under 10A, auditors who think something's going on, something illegal is going on, must ensure that the client's board of directors is notified. If you see something bad, you're auditing a company, tell the people in charge, tell the board of directors. If the board of directors does nothing about it, and go, oh, yeah, seems funky, and does nothing about it because they're the ones who are causing the problem, then the auditors have to actually reach out to the Securities and Exchange Commission. So it's giving you a process. It's saying as an auditor, check first, tell the board. Then, if the board does nothing, which they might not because they might be the ones causing the problem, tell the SEC you need to report that conduct. Not only are they rewarding you for doing that, they're telling you you have to. It's your job. If you see something sketchy going on, make sure you say something, especially if you're auditing the company. The SEC's Office of the Whistleblower was something they established under a newer act called the Dodd-Frank Act, and this is to help this kind of conduct and requirement from going on. What they do is they actually reward if they get high quality original information. Someone snitches and shares useful information, and it results in the SEC being able to enforce action and maybe give sanctions to an organization of over $1 million. You can actually be rewarded for that. They'll give you 10 to 30% of the sanctions that they enforce. So we've seen whistleblowers, they remain anonymous, but we saw one a few years ago got $14 million. The idea here is to try to incentivize people to do the right thing. Now, if you heard something sketchy going on in an organization, you'd say something, right?
Hell yeah, for
14 million. It sounds easy, it's not. First of all, if you work at that company, many people, especially in America, live paycheck to paycheck. If you say something, that company's going bankrupt, they're going to go under, you lose your job. Right? So that's one piece of it. It's not always so easy. WorldCom, they had a whistleblower, and she needed to put food on the table for her family. On top of that, WorldCom was in a really remote location, so pretty much like everyone in the community worked there. It's like all the people in the area, they all kind of worked for this one big business. So, she says something, and then all of her neighbors and friends and people she grew up with, they're unhappy with her, which is a problem.
What did she do?
We don't know. It's anonymous, whether or not she would have gotten something. Then, that was disruptive, I'm sorry. Then, on top of that,
Were they in our class?
No. So going back to what we were talking about, so think about that. Her community's upset with her because now all her friends and family lost their jobs. She doesn't have her initial paycheck to put on the table. And what do you think? Do you think it's going to be easier for her to go get another job in that field initially? No.
That's gonna follow her, right?
What'd you say?
Is that gonna follow her?
It's going to follow her for a long time because, you did the right thing, you reported, but do you want to hire that person who, might be saying, hey, well, your business has something sketchy going on, I'm going to report it, and they end up not hiring her, so she has a hard time getting a job. So while it sounds really easy to report bad conduct, it's hard for people because they're balancing a lot about how do I make sure I have money coming in, how do I make sure I have food on the table for my family, and I'm going to be blacklisted from this field for a while. And we have protections in place, right? So she can go to court and she can get her job back. Do you think she wants her job back there?
No.
The company probably doesn't exist anyway, but even if it still exists and she wants her job back, she probably doesn't want to work there anymore. They'd be probably kind of mean to her. Okay, and then in terms of back pay, she can get some money, but it takes 2-3 years to go through the court system before all the appeals and everything. It's just not a simple process. So don't feel bad for her. Cynthia Cooper did very well for herself. She wrote books and went around talking about doing the right thing and makes money now, but initially it was a hard choice and it wasn't an easy thing to do. So we have all these acts in place to help. Remember, the law doesn't always work perfectly. They're supposed to help. It doesn't always prevent this type of conduct. Go ahead.
So given all that and everything that happened to her and whoever else this has happened to, what would be the incentive of telling them?
What would be the incentive to telling them? I would not want to be at the company that was doing the wrong thing when they go down. What's funny, there's Accenture used to own Arthur Andersen. They were the auditing company for Enron. Would you proudly say that you were auditing Enron that had all these financial issues? So I personally would want to work for a company that, gets into trouble. Then you're associated accomplice, right? You're helping a company that's doing the wrong thing. So ultimately, people often want to say what's right instead of being caught up in it. Also, you can face legal charges. Now, if you're the person who's looking at these financial statements or you're involved in this in some way and the company gets in trouble, you personally could be in trouble. So it's better to report it when you see something's wrong so you're not a part of the problem, you're part of the solution. Go ahead, Glenn.
You kind of just answered it, but I was going to ask if someone has been responsible in the past and then kind of been the problem and then was the whistleblower of themselves so that they could try to turn on everyone else and collect the money.
Yeah, so Glenn's asking, what if you were part of the problem for a long time and then, finally you go, well, hey, this is bad, I should say something. That happens all the time. Again, you guys use the word snitch. Often in order to make sure that you don't face criminal liabilities, people will make a deal with investigators to help collect information. They'll help them get access to the information they need in order to get what's called immunity, to not face charges. Now, a lot of people talk about whether or not that's fair. The idea there is, we'll get Glenn, regular sales associate, to help us get the information we need so we can take down CEO Rebecca. Okay? And by having his help along the way, we can get more evidence to make sure Rebecca's going to jail because we want to get the really, really big fish. Not as worried about Glenn, who is, probably not doing the right thing, but now he's trying to do the right thing by helping. And so that's the idea there. Criminal liability. So offenses which may be criminal offenses include willful violations of the 1933-1934 Act. So that's why that case we talked about was so important. You know, whether or not it's intentional is the difference of whether or not you could be going to jail. Now, under the accountant-client relationship, a client may create difficult situations as the accountant would lose the client if the business fails. So again, keep that in mind. We talked about this already. There's just this inherent conflict. You're the business, you hire an accountant. If the accountant discloses the fact that you're totally in debt and making no money, will your business continue to be successful? Probably not. A lot of the investors might pull their funds out. You can run into some financial issues. Can they afford to hire you any longer after that? No. So everyone kind of has this inherent conflict of interest to try to make sure the financial information reflects really highly on the business when sometimes it's not the real story. So that's our very, very quick overview of accountants' liability. What questions do I have about this? We've covered it at a very high level. Go ahead, Michael.
Just going back to the case, so if the customer filed it under negligence, would they have had a better outcome?
Yeah, and keep in mind they could have filed under negligence. So here, going back up here, okay. Ernst & Young for stockholder, they filed it under 1934. They might not have cared necessarily about the money. What they might have cared about was getting these people thrown in jail. When I lost millions of dollars because of you, I'm rich, I have plenty of money, but I want to make sure that you're penalized for it. I'm going to send you to jail. Under negligence, we'll learn in our next class, the outcome is money. We're looking to get money. So they can certainly go after them for negligence as well, trying to get their money back. Now, one thing to keep in mind about all of this, all those people who got hurt at Enron that lost their jobs, lost their retirement, lost a lot of money that they had invested with the firm, all due to a lot of fraudulent acts. If they sue, they win millions of dollars. Where's it coming from? Enron, which is bankrupt and out of business. So are they getting any money? No. So unfortunately, that's why we try to put a lot of laws in place to help. Because when these companies do bad things, they hurt all these people and they're losing all this money, slam dunk in court, they'll say, hey, you deserve your money back, but it's going to be hard to collect it when the business has gone bankrupt. So by going after bad actors, going after the CEOs and some of the managers, they might be able to get some money somehow. So you'll see them going after more than just the firm, but even still, it's going to be hard to collect. But sometimes jail's more fun. For those of you that want to talk about your exams one-on-one, I told you that I would save time now for us to do so. I will post this video so you have the accountant's liability uploaded. Anyone who wants to stay and ask questions or talk about the exam, you can.